Hello traders, you're welcome to this video and you're welcome back to the Forex Geek channel. This channel is your go-to channel for all things Forex trading. All right, trust me on that. We cover a lot of topics that you are going to find really beneficial for your trading journey. All right. But in this particular video, we are going to be diving into an easy to follow Forex swing trading system that is perfect for traders looking to capitalize on short to medium term market moves. Okay, this particular strategy is mostly for those who are looking for short term moves and medium term moves, not necessarily long term. Okay, however, you can still benefit from one or two things even if you are a fan of long term trading. All right. So swing trading basically is all about catching those sweet spots in the market where price movement works in your favor, right? It's not necessarily about chasing every move, okay, but identifying high probability setups that give you an edge. So by the end of this video, you'll have a solid framework for a swing trading system that you can start applying right away. Okay, first, let us talk about what makes swing trading unique. Unlike day trading, where you are glued to the screen, right? Swing trading focuses on holding trades for a few days to a few weeks. The goal, to capture larger price movements while minimizing over trading. Now, here's the good news, right? Swing trading fits perfectly with technical analysis. All right, so we'll use tools like moving averages, trend lines, and RSI to identify strong setups. Okay, it's all about timing your trades based on market cycles, catching the peaks and troughs as the market ebbs and flows, all of that. Now, let us just dive into the system itself. I'm going to be, going through a step-by-step breakdown. All right. The first thing as a swing trader is to identify the trend. Okay, you need to start with trend identification, right? You start with a higher time frame like the daily time frame or the 4-hour chart. Okay, you can actually start with the daily or you can start with the 4 hours, whichever one that you prefer. Okay, and then the essence of starting with these time frames are to identify the overall market trend. Okay, now let's just quickly go to the daily chart and we can see that on the daily chart we are in an uptrend. It's a clear uptrend. There is no negotiation about this, right? It's a clear uptrend. All right, then if you want to start from the 4 hours chart, you're also going to find that we are currently in an uptrend. That is, if you are using this latest move. But if you want to use a longer term move, then we are still kind of in a consolidation phase. So if we have a breakout from this point, then we are going to be expecting this particular bullish move, to continue. All right. Yeah. So once you have identified the trend from the higher time frame, the next thing is your key levels. Okay. Draw support and resistance levels to highlight potential entry and exit points. So just like I did here, you will notice that we have a key level here, a key resistance, which if broken, we are going to be looking towards further upside. Okay. And here we have a significant support around here, which if broken, we might have a significant decline, right? We might have a significant drop, perhaps to the nearest support. We might actually have a drop all the way down to this point, or perhaps this point, right? Okay. Now, after you have identified your key levels, these levels act as magnets for price action, right? Then the next thing is you can use indicators for confirmation. Okay, you can actually decide to use moving averages, like the 50 EMA or the 200 EMA. I'm just going to add both of them to the chart right away. Okay, moving averages are a great, indicator, right, which you can use for identifying trend. Yeah, and which you can use for a diverse kinds of strategies. Yeah, so moving averages come in really handy. Okay, when you are using your moving averages, basically you are using them to spot trend direction, right? So when you have your price or candlesticks above the moving averages, it clearly shows a bullish trend. and when you have the price below the moving averages, it clearly shows a bearish trend. Okay, but when you have the price, rising and falling, rise above, fall below, and then you have the moving average going sideways, it shows a sideways or a consolidating market. All right, now in addition to that, you can also add the RSI. Remember, we are talking about swing trading, right? We're talking about swing trading. Okay, so you can also add the RSI to the chart. The RSI is going to be helping you to identify overbought and oversold conditions, right? When you have the RSI level above 70, it shows an overbought condition, and when you have it below 30, it shows an oversold condition. So as a swing trader, you want to hold your trades for a couple of days or perhaps a couple of weeks, right? Depending on how long the trend lasts, because you are looking towards riding trends. Okay, so you're going to be aiming for taking advantage of trends, especially when the trend is just starting. But if you cannot capture the trend when it started, you can actually join the trend along the line. For example, if you had found when this bullish crossover happened, that would have been a good time to start, or rather to open a buy position, in the direction of this trend, because the bullish crossover from the moving averages indicates a buy trend. That a buy trend is about to stop, right? So that would have been a good time to join, the train on time. But if you had not entered a buy position on time, perhaps after this series of pullbacks, around one of these pullbacks would have been a good time to enter a buy, especially after the RSI dips to the 30 and then climbed back up. So this would have been a good time to enter a buy. Here again would have been a good time to enter a buy until when we finally had this consolidation. Now, this consolidation, if you don't want to take that risk, you can now decide to exit your buy. But if you want to take the risk, you can decide to trail your stop loss. Take your stop loss below this consolidation zone and then just leave your buy position open. So if we happen to have a breakout to the upside, you keep on riding the trend until it ends. But if we have a breakout to the downside, then your position gets closed, right? So when it comes to swing trade, you might actually have your trades running for days or running for weeks. It depends on how long the trend lasts. Okay. Now, it's always important to wait for price action confirmation, like a bullish or bearish candlestick pattern, okay, before entering your trade. All right. For example, before you enter your buy trade, it's important if you wait for a candlestick pattern to confirm that direction. All right. For example, after we had this bullish crossover here, the next thing for you to look out for is a bullish candlestick pattern, and the RSI was in the overbought territory, so this wouldn't have been a great place to enter a buy. You would have waited for RSI to dip a bit, at least to the 50 level, and then start going back up before you enter a buy, right? So this would have been a good place to enter a buy, because we can see a bullish candlestick pattern around here. It's going to look like sort of a morning star, right? We have a bearish candle, and we have sort of a doji, although it has kind of a big body, and then we have a bullish candle happening afterwards. So this would have been a good place to enter a buy right after this pattern, and we can see that the RSI dropped to the 50 level and climbed back up, in as much as this was the midpoint, because sometimes you might not always have RSI dip to the 30. Right, so you don't have to always wait for the RSI to dip to the 30. Most of the times, when RSI dips to the 30, it shows that there was really some strong bearish momentum. Okay, but in some cases, so long as the RSI drops to 50 and climbs back up, you can use that as a confirmation to enter a buy. So long as it climbs back up, okay, and you can see here again, you can see this was just a pullback. It pulled back to the 50 and continued. Here again, it's pulled back close to the 50. In fact, you can see a series of pullbacks to the 50 level and continuation. Then here, the reason why it dropped to the 30, you can see that there was a really strong bearish momentum, okay, before it dropped to the 30, and then we had a continuation. All right, so basically, always ensure you get your confirmations before entering your trades, and even before exiting, try to ensure that there is, a valid reason why you want to exit your trade. Perhaps you're having a long consolidation, or you are seeing a pattern of a reversal. Okay, and then after the trade is complete, review what went well and what could be improved. The key to long-term success is learning from each trade. All right, and then even in terms of stop loss, try to aim for a risk to reward ratio of at least 1 to 2. So if you are entering a trade and you're setting a stop loss, below your swing low, for example, if this is a buy trade, or above your swing high, if it's a sell trade, then your target profit, you should be aiming your target profit to be at least ×2 of what you are risking. All right. Now, consistency is what separates average traders from great ones. So here are 3 quick tips for you. All right. The first, stick to your trading plan. Don't let emotions dictate your decisions. Okay. Secondly, be patient. Swing trading isn't about instant results. It's about making calculated moves. And then finally, always manage your risk. Never risk more than 2% of your account on a single trade. All right. And that is it for the Forex swing trading system in a nutshell.